Okay guys, this is what we have here. We have buy side liquidity at this level here, and then we have the shift in market structure here. Okay, because we can see that our price broke this structure here, and after it broke this structure here, we can see that we have a lot of imbalance here. Okay, so what we're gonna do, we're gonna look for any institutional reference point, okay, and anticipate a retracement after price has broken this structure here. We're going to anticipate a retracement to the upside. Okay, so what we're going to do, we're going to be looking for any institutional reference point at this point. It's going to be a fair value gap here, which we have indicated here, and also you can see this is a fair value gap here. So let me just put this here. So you can see we also have a fair value gap here. This is a fair value gap, and this is a fair value gap here. So what we're going to be focusing, we're going to be focusing on fair value gaps above 50%. Okay, so above our equilibrium, that's the fair value gap that we're going to focus our attention to. Any fair value gap that is below our equilibrium, we're not going to be taking it. Okay, so this is going to be the fair value gap that we're going to be looking at. So we can see that this fair value gap is close to our 70% of our fib, okay, which is going to be our SMC, and our OTE, which is our 79% of the fib, and this is our 70% of the fib. Okay, so we want to look for fair value gaps that are at premium. Whenever we are looking for bearish fair value gap, we want to sell only those fair value gaps that are above premium. Okay, so only those fair value gaps that are above 50% are the ones that we're going to be considering when selecting our fair value gaps. Okay, so the same is true here. You can see here there's a clean re-entry here if you missed the first one. So you can see here this fair value gap here, it starts here, it's end here, and you can see our 50, our equilibrium, it's here, or our 50%, it's here. So these fair value gaps here, this fair value gap qualifies to be taken. Okay, so as you can see, price already got into this level here. Let me just highlight this level. So this is the level of our fair value gap here. So this fair value gap here, it's created within this level of this fair value gap here, or within the range of this fair value gap here, which is why I will be skeptical about price getting to this fair value gap here. Hence, this is gonna be the fair value gap that I will be anticipating. Okay, this is the fair value gap that I will be anticipating. So you can see price got to this fair value gap here. It respected this fair value gap. Beautiful. So if you are not sure about the fair value gap, wait and see. Price gets to this fair value gap, boom, it spikes this fair value gap, it closes below. Okay, so at this moment you can enter here, since you see that it seems as if price is respecting this fair value gap. Okay, if you are still skeptical, here's a second confirmation. Price push up and it close outside this range of the fair value gap here. The body of the candle are outside the range of this fair value gap here, indicating that there is a lot of momentum to go down. Okay, there is a lot of momentum to go down. It indicates the momentum. So you can see here it didn't do the same thing, but it went down. Okay, so this just indicates the momentum, and you can see how it went down. Okay, because there is a lot of momentum to go down. So that's what we have. Let me remove this and then we start the lesson. So what you're going to be looking for, so this is the low here that begins this rally, as we have said. Okay, so this is going to be our significant low to indicate a shift in market structure. Okay, so this is going to be our main low to indicate a shift in market structure. The reason it is our main low to indicate a shift in market structure, it's because this is where the rally begins. Okay, the rally begins here of going up to take out this buy side liquidity here. Okay, so when price took out this buy side liquidity here, what we were expecting, it's either a retracement a reversal or a continuation. And in this case, we can see that price pushed down, and when it pushed down, it broke this structure here. If you look at this time frame, because this is 4-hour time frame, you might think this is not a prominent structure unless you go to a smaller time frame, or unless you have been trading for a while, you can tell that this is a structure in a smaller time frame. So let's just go to 1-hour time frame, and I get to show you that this is a prominent structure. So you can see that this is a prominent structure. Let's go to 30 minutes also. So you can see on 30 minutes, this is a prominent structure. And you can see something interesting. If you look in 30 minutes, you can see here, we have an order block at this level here. There's an order block here. So this is the importance of looking at the smaller time frame, because such trades, sometimes you might not be able to get them. Okay, so you can see here, there's an order block here. Price push to this other block here, and you can see we have these here, because this is also a high. Okay, this is a high here. I mean, this is a high here, and this candle here, it's what we call a propulsion block. Okay, so this candle, it's what we call a propulsion block. So you can see price, it's within the range of the propulsion block, and then it pushed down. Okay, and after it pushed down, it creates a mini fair value gap at this level here. There is a fair value gap here. Doesn't even close that fair value gap, and it quickly pushed down and come back to this fair value gap here. Okay, so you can have your entry here if you are willing. If you are not willing, I believe if we can go to a smaller time frame, let's see. In as much as we are looking at the bigger time frame, but we need to consider the smaller time frame. That's why whenever you get to do your analysis, you go to a smaller time frame so that you get to find the refined entries. So when we talk about the refined entries, we are talking about something like this. You see something on the bigger time frame, then you shift to a smaller time frame. So let me look at this and see on 5 minutes if we can find anything. All right, now it's taking a lot of our time scrolling. So let's just leave it and come back to our bigger time frame. So as you can see, the entry was somewhere here, but if you looked on this time frame only, you might not be able to see the entry, or you might not be able to see that there is a change in market, there is a shift in market structure happening within the smaller time frame. Okay, so first thing first, a lot of things, they first appear on the smaller time frame because before they can be visible on the bigger time frame. So if you go to the smaller time frame, you get to be some sort of ahead of the bigger time frame. Okay, so because you can make your entry here, and when you look at the bigger time frame, there is really nothing much here that can convince anyone to make their entry here unless they've been looking at the smaller time frame. So that's the advantage of the smaller time frame. So we have already seen that this is a well-established structure here. So that structure here, price push down, it break this structure here, and then it retraces back, gets to this level here of our fair value gap here. So if you were able, you can take a position here targeting this low here. Okay, so price push down, gets to the push up, gets to this level here, and it quickly go down, takes this shift in market structure here. And then once we have this major shift in market structure being taken out, guess what price does? It retraces, gets to this level of our fair value gap here, and then after that it pushed down. We have a shift in market structure here. We have buy side liquidity being collected, shift in market structure here, and then price push back, gets to this level of our fair value gap here. So this is your entry here, and this is your re-entry here. In case you miss this entry, this is your re-entry here, and price, boom, it gets to this level here, this level of our targeted sell side liquidity. This way you get out. So basically that's it. There is nothing difficult about trading volatility index or trading this model. The only thing you just need something like this. You just need a shift in market structure. Okay, so price push up, something like this, and then it push down, and then this is gonna be a retracement. You enter somewhere here. This is gonna be your buy side liquidity, and then this is gonna be your sell side liquidity. And this low here, it's the low that will indicate to us a shift in market structure when it's broken. Okay, so this is gonna be the low that is gonna indicate a shift in market structure when it's broken. When it indicates a shift in market structure, it simply means that our price is now going down. It has already changed direction. Okay, so since we have a shift in market structure here, whenever we get to see price retrace, whenever we get to see price going down, we assume that it's gonna be a retracement and price will continue to go down. Okay, because we have already established here that we now have a bearish shift in market structure. Okay, so that's the same thing here. You can see what price did here. It took out this low here, which indicates that now we have a bearish shift in market structure. So this retracement here, to us, it's most likely going to be a retracement. So we're going to be looking for any institutional reference point here. So we look for those institutional reference points, and then price, boom, gets to this level, and then it push down. Okay, so basically that's it.